Hi there. Welcome to the Value Investing Fundamentals course, brought to you by Wealthy Education. In this course, I'll teach you how to get started in value investing fast. You'll learn exactly what you'll need to do when evaluating a company and what you'll need to look for when picking a stock to invest in. So if you're just starting out, or you're looking to learn value investing fast so you can start growing your retirement funds or portfolio more quickly, this is the course for you. Here's exactly what you'll learn in this course. In this course, we'll provide you with a strong value investing foundation. I'll teach you 3 easy, simple steps that you can follow to find and invest profitably in value stocks. You'll learn exactly how to assess a company by looking at 3 different types of value. This is critical because most investors only look at 1 or hopefully 2 when evaluating a company that they want to invest in. And that's why they end up buying a cheap stock at a much higher price. You'll also learn how to use a margin of safety to significantly reduce risks on your investments and correct all the mistakes you might make in your valuation process. I'll also teach you 7 golden value investing principles that every stock investor should live by. And in the last module, we'll also talk about 5 different things you can follow to identify if a company has a sustainable competitive advantage, so it can compete with other companies within the same industry. And we'll also make a complete value investing roadmap for you so you know exactly what you need to do now and what you'll need to do next. You'll know exactly your next steps and what you'll need to learn to become a successful value investor. Hey guys, welcome to Module 1. In this module, I'll help you understand quickly how the value investing strategy works in the real world. We'll dive into what exactly value investing is, how it works, and I'll show you 3 simple steps to implement this strategy so that you can profit from the stock market and grow your money. Okay, now let's get started. So what exactly is value investing? Value investing is simply an investment strategy where stocks are selected that trade for less than their intrinsic value. So what does that mean? Intrinsic value here is a real or true value of a company. By doing value investing, you simply invest in stocks that are currently undervalued or become temporarily cheap. Value investing is driven by the idea that there are ways to benefit financially from the events that cause stock market prices to swing up and down. So when there are rumors or bad news about a company, its stock price will drop. And as a value investor, you simply take advantage of these events and buy the company's stock at a much lower price. On one level, a stock's value is reflected in its current market price. Since the market price indicates how much investors are willing to pay for a stock at any given time, it indicates the stock's market value. But the key point to note in value investing is that a stock's market value is not the same thing as its fundamental or intrinsic value. Sometimes businesses can become temporarily popular or unpopular for a variety of reasons that have little to do with the true worth of their revenues, net assets, or their future income potential. So, as a value investor, our job is to find a company's true value and compare it with the current market price, so we can determine if the stock is worth buying or not. When a company's stock is undervalued, it means that it's selling at a price well below the value of its current and predicted cash flows. For example, a stock is selling at $3.21 a share, and you find that it's actually worth $5.67 a share. So this simply means this stock is undervalued, and it's a good buying opportunity because you know that the stock price will likely go up in the near future. So you simply buy low at $3.21 a share, and then sell high at $5.67 a share, for example. In this case, you can make around $2.50 a share in profit. At the same time, a stock that's overvalued is one that's selling at an inflated price, well beyond its true value or its predicted cash flows. For example, you find a stock that's selling at $5.67 a share, and after applying some valuation techniques, you know that this stock is only worth $3.21 a share. So this means it's overvalued or expensive to buy. There are chances that its price will drop in the near future, so we simply sell it or avoid buying it. You see, value investing can tell you exactly whether or not a stock is a worthwhile investment. With this information, you can easily profit from the stock market. So what is the smartest strategy for buying and selling stocks? As a value investor, we'll buy on bad news and sell on good news. Do you know why? Well, most investors will do the opposite. They buy on good news and sell on bad news. That's risky because they can easily buy an overvalued stock which likely drops in value. For playing safe with the stock market, why don't we wait until there are some rumors or bad news? These events will likely cause the stock price to drop temporarily, and the stock can easily become undervalued. And then we can buy low and sell high for making an easy profit. And similarly, we'll sell on good news because chances are the stock price will surge temporarily during these events and sometimes become overvalued. We simply sell at a high price and take the profit. So here's a quick tip. If an undervalued company is financially strong, with a solid profit history and promising future earnings, its market price is very likely to rebound after a temporary downswing caused by investor fear or disfavor. This means solid companies with efficient operations and strong financial performance are always winners. We don't care when their stock price drops because of bad news or rumors. Their financial performance proves that they can survive market downturns, and their market values will likely go back up and reach closer to their intrinsic values. So, to be a profitable value investor, all you need to do is find companies with a strong fundamental performance. In the next lecture, I'll teach you how to implement the value investing strategy. In this video, we'll talk about 3 easy, simple steps that you can follow to invest in a value stock. The best value investing strategy starts with learning to identify fundamentally strong companies. If you attempt to profit by buying stocks that have simply dropped in price, without first ensuring that they have the underlying ability to eventually recover, there's a good chance you'll experience some financial loss instead. An effective value investing formula dictates that we must first look for strong businesses, buy when their stock is undervalued, and sell when it rebounds or becomes overvalued. Now, let's dive into each step so you can understand clearly what to do and how you can profit by investing in undervalued stocks. Value companies are not named for their positive market values, since every company's stock price fluctuates on a regular basis in conjunction with individual news events or occurrences within the market as a whole. A fundamentally strong business is known as a value company because it possesses actual inherent worth in terms of its consistent earnings, dividends, and cash flows. So, you want to make sure you'll only invest in companies with a consistent growth in earnings, dividends, and cash flows. These companies usually have a sustainable competitive advantage over their rivals that keeps them in the game, regardless of what their stock price may be doing from day to day. And it's this competitive edge that gives businesses a protective economic moat. Economic moat is something that helps a business remain financially competitive over the long term. We'll go into more detail about economic moats in the next modules. Even if negative events can cause a fundamentally strong company's stock price to dip, and here's an important thing, if that company can maintain its ability to continue operations as usual, it will rebound in time to a market price that is more in keeping with its true value. I want you to note that investors tend to have emotionally short memories. They won't remember what happened with the company in the past, and they only care about the present and the future. So as long as a company continues to demonstrate a consistently growing net income and cash flow, it's very likely to not only eventually regain its former glory after a price drop, but to become overvalued someday because investors start to recognize all over again what a great value it represents. And when looking for fundamentally strong businesses, some additional factors you should keep in mind are low debt and the presence of a strong and responsive management team. Overall, if a company has a history of performing well, you can predict that it will continue to do so over the long term. Once you've identified businesses that are fundamentally strong and that have a high intrinsic value, your next step is to add them to your watch list so you can buy them if and when they become undervalued. Under normal circumstances, stocks that are financially strong and that demonstrate promising future prospects are maybe too expensive to buy. For this reason, a fundamentally strong business doesn't always represent a good investment, because its stock value will have little potential to increase if you buy it when it's already trading at a price that's more or less in line with the company's intrinsic value. So in short, you need to learn how to find undervalued stocks, so you don't end up buying them at the wrong time. But there's good news. A strong company can easily become temporarily undervalued for a number of reasons. These can include one-time events, such as internal scandals or negative news reports that cause disillusionment, but make sure that these events don't cause the company to lose its competitive edge or its ability to go about its business as usual. If you wait for such occurrences as a company failing to meet its projected earnings, a downturn in the economy, a significant change in a company's business environment, or similar types of bad news, you'll find many great opportunities to buy a great stock at a very low price. These events will likely cause a stock price to drop, and when this happens, chances are it will become undervalued or cheaper to buy. And as a value investor, you simply buy low and then sell high to make a profit. Now that you understand the best time to buy into a financially strong company is when its stock has become undervalued, you also need to know when to sell that stock in order to make a profit. Although we know that a high-quality company can be temporarily affected by negative market news that causes its stock price to plunge, we also know it's very likely to recover over the long term. And in the same way that bad news can cause a company's stock price to drop, good news can have the opposite effect and cause its price to surge during this recovery period. When a company publicly announces how well they did financially for the previous quarter, that makes investors feel excited, and they want to invest their money in that company. And when the demand increases, the stock price simply goes up. In either case, whether a business simply recovers its true value in time because of its intrinsic value, or becomes suddenly overvalued as the result of some positive event like share buyback, it will be the time to sell your stock and take your profit in the spirit of buying low and selling high. So I want to pay close attention to these events because they can help the stock price go up very quickly. And you'll also have to be quick to sell your stock and take the profit. Share buybacks and stock splits are common events that can lead to an increase in a company's stock price. Share buyback is a program by which a company buys back its own shares from the marketplace, usually because management thinks the shares are undervalued. And stock split happens when a company divides its existing shares into multiple shares to boost the liquidity of the shares. So as a value investor, we can take advantage of these golden opportunities to sell our stock at a temporarily high price and make a higher profit. And the stock price tends to go up during a bull market or economic upturns. And events like mergers and acquisitions can also lead to a significant movement in stocks. A merger is when two companies merge together. An acquisition is when one company buys out another company. So you need to pay attention to these events, especially the earnings announcement, because it happens almost every quarter, so we'll have at least 4 times a year to make big profits. In the next lecture, we'll talk about price and value, which is a very important topic in value investing. Okay, see you in the next video. Price is what you pay, value is what you get. Okay, now let's talk about price and value. Both price and value are the two sides of the same coin. Understanding the difference between price and value is important because it helps you sort out good investments from bad investments. So I want you to take a quick note here. Price and value are not always the same. Most inexperienced investors look at a stock's price to determine if it's cheap or expensive. They think that a $5 stock is cheaper than a $50 stock. Well, it seems cheaper because of the price tag. But they don't know that their $5 stock may be only worth $2 or $3, for example, while the $50 stock can be worth over $80 or maybe $100. So that's the difference between price and value. Looking at the price side is not investing. It's gambling, because you have no idea about how much your stock is actually worth. Only considering the market price is the same as you go shopping. You buy a product because the shop tells you that there's a promotion. They discount the product and you feel you're buying something cheap. But the thing is, even with a discount, that shop can still make a profit because they're selling you a product at a price that's higher than its cost of production, so that product is overvalued. The same for the stock market. As a value investor, we need to look at the value side. So before making your investment in a company, you need to make sure that you'll only buy it when it's undervalued. There are 3 types of value that you need to know about if you want to be successful as a value investor. Evaluating these values carefully will show you a clear picture of how profitable a potential investment is. The first is relative value. The second is absolute value. And the third is perceived value. Now, let's dive into each of them in turn. Relative value can be determined by comparing a company's financial performance with that of its competitors within the same industry, and also with the industry average. The differences between a company with its rivals tells you exactly how well it's operating and generating profits. When a company is profitable and able to operate efficiently, that will make a significant contribution to its shareholders' value. This simply means the more profitable the company is, the more profitable you are as a shareholder. So to determine relative value, the easiest method you can use is performing a financial ratio analysis. We'll simply compare a company's profitability, efficiency, liquidity, and solvency ratios with that of its competitors and the industry average. The company with the best ratio values will be the best company in the industry, and it's a worthwhile investment in terms of its relative value. Financial ratio analysis is a big topic in value investing, so I'll teach you how to use financial ratios the right way in another course. But right now, you just need to know that it exists, and you'll need to learn about it later to master your value investing skills. Okay, the second value that we're going to talk about is the absolute value. In short, it's the company's intrinsic or real value. You'll need to perform a stock valuation to estimate your company's intrinsic value. Then compare its value with the current market price. If the intrinsic value is higher than the current market price, or the company's stock is selling at a price which is cheaper than it's actually worth, this means it's undervalued or cheap to buy. So, we'll consider buying it to make a profit when the price increases in the future. And on the other hand, if the intrinsic value is lower than the current market price, the stock is overvalued or expensive. We simply avoid buying this company's stock. So to determine absolute value, we'll use some valuation methods such as the discounted cash flow model or dividend discount model. Okay, the final one is the perceived value. Perceived value is the price that people are willing to pay for a product or service. And in the stock market game, it's the price that people are willing to pay for a share of a company. The perceived value is completely unrelated to the absolute value. The best example of perceived value is this picture. It's actually worth maybe just a few $100s to pay an artist to paint it. But guess what? It's worth millions of dollars. Why? Because there are people who are willing to pay that high price to own this picture. The selling price will totally depend on the perception of the buyers. And I want you to know this. The stock market also works on the perceived value, and the stock price of a company reflects the perception of investors like yourself. You can easily see perceived value in growth stocks, where companies are growing much faster than their competitors and the whole industry. So that's why investors are ready to take higher risks and pay a higher price for owning those stocks. And to determine the perceived value of a company, you'll need to do a qualitative research. You'll need to find out what people think about that company, how skillful and experienced its management is in growing their business, what the values are that the company brings to the world. And the only way to know this is spending a lot of time reading news, stock analyses, and customer reviews. In the next lecture, we'll talk about another important topic of value investing. That's the margin of safety, one of the most critical factors that will determine your value investing success. Okay, see you in the next video. In this video, we're going to talk about the margin of safety and how you can use it effectively to reduce risks on your investment and make a wiser investment decision. So what exactly is margin of safety? Margin of safety is simply the difference between the intrinsic value of a stock and its market price. For example, the market price of a stock is $6 a share. You find that its intrinsic value is about $10 a share. So in this case, we have a margin of safety of $4, or 40%. In fact, the higher the margin of safety, the lower the risk on your investments. The margin of safety is achieved when a stock is bought at a price which is sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world. Or in other words, using a margin of safety will allow you to correct your mistakes in your investment analysis and valuation. Well, when it comes to stock valuation, we make mistakes all the time. Every valuation method is implemented based on assumptions. For example, when using the discounted cash flow model, you'll have to assume that a company's cash flow will grow at a consistent rate over the next 5 to 10 years. What will happen if its cash flow grows by 10% this year, 5% next year, and negative 8% in another year? You see, our valuation method is somewhat biased, and that's why the margin of safety concept is applied to value investing. So how much margin is acceptable? Well, it depends on how much bad luck you're willing to face, your risk tolerance, and how much money you can afford to lose. Losing some money is an inevitable part of investing. In fact, there's nothing you can do to prevent it. But to be a sensible and intelligent investor, you must take responsibility for ensuring that you never lose most or all of your money. If you think you can't afford to lose much from your stocks, it always pays to have a good margin of safety, say around 30 to 40%. This means that you must buy a $10 stock for not more than $6 or $7. Remember, the higher the margin of safety, the better. And also make sure that you will always use a margin of safety of at least 25% for the sake of your money's safety. In the next module, we'll dive into some investing principles that you should always keep in mind when investing in the stock market. Okay, see you in the next video. Hey guys, welcome to Module 2. In this module, we'll talk about some value investing principles. You don't have to be a legend to generate market-beating returns with a value investing strategy. But if you want to understand how to be a successful value investor, it will help to keep these principles in mind. Okay, the first point you need to acknowledge is that value investing is not gambling, and you should approach it with a full understanding of exactly what type of investor you are. And most importantly, you must understand exactly what you buy and why you buy it. Knowing the what and the why here is very important. Value investing isn't a passive strategy. Far from being a guessing game or a gamble, value investing is work. When evaluating a company, you should be able to answer the following questions and explain everything in your own words. What does the company you're investing in do? How does it make money? What are its competitors? What are the potential risks that it may take? And why do you expect its stock price to rise over time? It's important to know these things when you first invest, of course, but it's just as important to stay up to date on major developments affecting the company so that you can continue to answer those questions accurately. At a minimum, you should read the company's quarter reports and keep at least a half eye on news pertaining to the company so that you understand if its situation is changing. If something happens that lowers its intrinsic value, you'll need to reevaluate it. Do you still have a good reason to own the stock? If the company you own takes a turn for the worse, with no likely recovery on the horizon, selling its stock may be the best option, even if it means taking a loss. When it comes to investing, minimizing your risks is important, and that should be your first priority. So, that's principle number 1. Understand what you buy and why you buy it. See you in the next video. Okay, the second principle. Make sure you'll always invest in a cash-rich business. When a business is cash rich, it means it always has abundant funds left over after paying all of its debts and expenses. It also means that its assets are liquid enough to be called upon should they be needed as an extra source of cash. So more cash simply means more liquidity. That's exactly what you'll want to look for as a value investor. And you should always make a point of investing in companies that have a strong cash position, because they're the ones most likely to pay regular dividends to their shareholders. At the same time, these companies are less likely to find themselves so strapped for cash that they are unable to service their debt loads when revenues dip or a recession hits. However, having a lot of cash is not always a good sign. You must find out if the management is utilizing their business cash well. Warren Buffett once said, "When people talk about cash being king, it's not king if it just sits there and never does anything." If the management can't utilize their business assets, it shows inefficiency in the company's operations, and that will be a red flag that you need to pay attention to. And finally, you'll want to look for cash-rich businesses with a long and uninterrupted history of dividend payments. When companies pay dividends on a consistent basis, they demonstrate stability and show a positive sign that after paying all expenses and debts, they still have a lot of cash left to pay dividends to you and other shareholders. And that helps increase shareholders' value and in some way contributes to a growth in their stock's perceived value. Okay, that's principle number 2. Make sure you'll always invest in a cash-rich business. See you in the next video. Okay, besides looking for cash-rich companies, make sure you'll only invest your money in companies with a low level of debt. You're unlikely to find any well-established business that doesn't carry some level of financial liability. In fact, a little debt can be a good thing when it helps to provide the funding for business growth and expansion, since this type of activity tends to raise the overall value of a company. But that doesn't make it acceptable to invest in a business that's carrying a large debt load, since it's very easy for a company to get into trouble once it overextends itself financially and is no longer able to service or repay its loans. That is to say, having too much debt can lead to many financial troubles. So, as a value investor, you should be careful when picking a company to invest in. When looking at a company's financial statement, you'll find that there are 2 types of debt: short-term debts and long-term debts. For evaluating a company's short-term debts, you can use liquidity ratios. And for evaluating the long-term debts, you can use solvency ratios. To find out if a company's debt level is high or low, you can compare its debt ratios with that of its rivals and the industry average. And finally, you should also evaluate the company's ability to repay its short-term and long-term debts. If it can generate enough cash flow to pay its bills on time, there may not be any problem. However, if the company fails to pay its bills on time, it's going to have a problematic relationship with its suppliers and lenders, and that will affect the business in the long run. Remember that when you buy shares in any company, you are effectively lending that company your own hard-earned money. So make sure that you'll only seek out businesses with low debt loads and a reliable track record for repaying their debts. So that's principle number 3. See you in the next video. Okay, besides looking for low debt and cash-rich businesses, the next thing you'll want to consider is the quality of a company's management. In most cases, a company is only as successful as the people running it, and a big part of value investing is making sure that the business you buy into has a reliable, experienced, and forward-thinking management style behind it. One of the key factors in determining whether or not a business is on top of its game is to have a look at what gives it its competitive edge in the marketplace, and whether or not its management team has an ongoing plan in place for making the most of this competitive advantage. This means that management is not only acknowledging the competitive challenges that constantly threaten their company, but is adapting and responding to those challenges in a realistic and timely manner. To determine how well a company's management is doing in operating and expanding their business, you can use some efficiency ratios. And another great way to evaluate the quality of the management is looking at their company's competitive advantages. You need to make sure, to the best of your ability, that the people you are trusting your money with have proven themselves as effective decision makers and leaders within their industry. We'll dive deeper into how to identify a company's competitive advantages in the next module. Great companies should have great management teams. A great management team should focus on generating growth over time, which is the best way to reward long-term shareholders like yourself. So make sure you keep in mind principle number 4. Only look for companies that have both strong management and a sustained competitive advantages. And see you in the next video. Okay, let's talk about principle number 5. If you want to become a successful value investor, avoiding losses should be your first priority, even over generating investment gains. Remember rule number 1, never lose money. And rule number 2, never lose money. And I can tell you rule number 3 and number 4. Again, never lose money. Here's an interesting fact. It's simple math. If your portfolio's value drops by 20% and then grows by 20%, you've lost money. More to the point, in that situation, you need larger returns to meet your goals over time. That might lead you to take larger risks than you should, which could lead to more losses. As a value investor, you can minimize the risk of big losses by investing at a discount to a company's intrinsic value. And that's why you need to use the margin of safety as a part of your valuation process. While you may not always get market-beating growth, but if you can minimize losses and the need to recover from those losses, you'll need less growth to meet your investing goals over time. And besides giving yourself a high margin of safety, there are many ways you can go about minimizing losses on your investments. For example, you can easily avoid common costly mistakes like overtrading by only investing in companies that you're sure that you'll make a profit with. And before making any trade, you should always have an entry and exit strategy in mind. And don't forget to place a stop loss to protect your money. Okay, that's principle number 5. Never lose money. See you in the next video. Value investing strategies are not for those investors looking to move quickly in and out of stocks on a daily or even an annual basis. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." When you invest in value companies, you must invest for the long term and think in terms of years or at least months, not days or weeks. In fact, Buffett believes that all short-term price movements in the stock market should be disregarded by value investors, beyond using them as an indication of the best times to potentially pick up some new holdings. You should keep in mind that long-term investments are normally those that have lower risks. Rather than watching daily stock prices, you should spend that time keeping your eye on the operational performance of the companies in your portfolio. And rather than allowing market volatility to lead you into hasty and emotional investment decisions, you should continue to base your opinions of a company's value on facts. Sometimes it can take a company a long time to see its share price rise to match its intrinsic value. If you have the time, and if you won't need the money for many years, you have a huge advantage over investors with the opposite circumstances. You can buy, perhaps at a discount, when they need to sell. Good companies can trade at valuations that seem very low for years. This can happen when investors' attention is focused elsewhere, on hot tech stocks, for example, or when a sector is out of favor. Even if it takes several years to happen, the general principle holds. The market is usually efficient over the long run, and eventually, a stock's price will reflect the company's true value. If you've bought the stock at a discount, you'll make money, or a lot of money, if you sell it once its price rises to something closer to its intrinsic value. Having the patience to wait until that happens is one key to success as a value investor. So that's principle number 6. Make sure you have a long-term investment strategy in mind, and patience is key to your investment success. Okay, the final principle that you should keep in mind: know when to sell your stocks. Almost as difficult as knowing when to buy your stocks is figuring out when it's the right time to sell them. If a company is performing well, with no indication that its future growth potential has diminished in any way, then you can hold on to their stock until its market price exceeds its intrinsic value. Or in other words, you can hold your stocks until it becomes overvalued. Sometimes, however, stocks can become overvalued for the wrong reason, and this can be a warning that a severe crisis is in the works. The most common event that leads to a movement in stock prices is when companies release news about a new product line or management change. It can be good or bad news. If it's a positive reaction, the company's stock price will rise. If it's bad, the stock price goes down. Without question, the most important factor that affects a company's value, and therefore its stock price, is its earnings. Earnings are the profit a company makes, and in the long run, no company can survive without them. If a company's earnings are better than expected, its stock price increases. But if a company's results are worse than expected, its stock price will fall. Simple as that. Another factor is market volatility. Stock market volatility often leads to stock price declines across the board, even for companies with strong business fundamentals. Market downturns could be due to several reasons: changes in the economy, profit-taking after strong rallies, and geopolitical events. However, in such circumstances, stock prices may just decline temporarily, and chances are they'll recover in a few months. So you can take advantage of these scenarios to sell your stock at a high price and then buy it back at a lower price. It's a simple strategy for guaranteed profits. Another circumstance you should consider selling your stocks before everything gets worse is when the company suddenly cuts dividends without any acceptable reasons. As a value investor, we understand the importance of dividends, so you need to be wary when dividends are suddenly cut. 90% of the time, your stock price will plunge because investors no longer feel safe about their investments, and they're so concerned about the business performance. So, that's principle number 7. Know when to sell your stocks. In the next module, I'll teach you how to identify a company's economic moats so you can easily determine if a company has sustainable competitive advantages over its industry peers. Okay, see you in the next video. Hey guys, welcome to Module 3. In this module, I'll teach you how to identify a company's economic moat, as well as understand how wide it is and why it's so important. So what exactly is an economic moat? While regular cash flow, well-managed debt, and a competitive advantage all play a role in enduring business success, the ability to develop a wide economic moat is the key to what separates the winners from the losers over the long term. What we refer to as a moat is what other people might call competitive advantage. It's something that differentiates a company from its nearest competitors. In very simple words, an economic moat is basically anything that gives a business some form of built-in protection for its ongoing generation of cash flow. If you picture a company as a castle that is constantly under attack by its enemies, or competitors, you'll have a better understanding of just how important an economic moat is in helping a business to thrive and survive in the marketplace. And here's what you should keep in mind when evaluating a company. Without one or more protective moats firmly in place, a formerly profitable business will soon find itself unable to maintain its market share, and its revenues will begin to drop off. This also means that a company without a unique economic moat can't survive in the long term. It'll be harder for it to compete with other companies within the same industry, and it'll be harder for it to recover from market downturns, recessions, or financial disasters. Remember that a competitive advantage is essentially any factor that allows a company to provide goods or services that are similar to those offered by its competitors, and at the same time, outperform those competitors in profits. So the easiest way to determine the size of a company's economic moat is look at its historical operating performance. To evaluate a company's operating performance, you can use some profitability and efficiency ratios. Then you can compare its ratio values with that of its competitors and the industry average. If the company you're evaluating maintains a better and more efficient operating performance than its competitors, it's clearly the winner, and you can expect that it will survive in the next decades. In the next video, I'll give you a complete list of economic moats that a company may have, and I'll also talk a little bit more about economic moats and why they're so important. Okay, see you in the next video. The concept of the economic moat comes from Warren Buffett. He evaluates a company's economic moats to determine its ability to maintain a competitive advantage over its rivals, and thus protect its long-term profitability and market share. So why do companies need a competitive advantage? A competitive advantage is any quality that enables a company to offer similar products to its peers while enjoying superior financial performance. Over time, companies are more likely to lose their competitive advantage because, as they grow increasingly profitable, competitors are more likely to replicate their methods or create even better ones. As soon as the level of a company's profits is significant enough to warrant attention, it opens itself up to attack from competitors who are looking to enter the marketplace with the intention of grabbing a share of those profits for themselves. This is exactly where a wide economic moat offers the protective barrier a business needs to prevent other companies from stealing its earnings. Or in other words, establishing economic moats can help companies protect their long-term profits. In reality, an economic moat serves as a competitive advantage over other companies within the same industry. But what sets it apart is the fact that the advantage is sustainable over a very long period of time. While these moats can be created in a number of different ways, and may be either narrow or significantly wide, it only stands to reason that the more of them a business can build, the better off it will be. Let me ask you a quick question. How can you feel confident about estimating a company's ability to generate earnings down the road if that ability is not protected in some way? Sustainability is the key to consistent and ever-growing revenues, and the economic moat is the key to that sustainability. While having a competitive advantage may allow a business to temporarily outperform its competitors, the economic moat is a benefit that's built to last, and it will ultimately determine whether a company is set up for prolonged success or inevitable failure. From an investment point of view, the longer a company's economic moat can hold firm, the longer you will benefit from its profits. It's important to be aware that there are some false business moats in the marketplace, masquerading as the real thing, and you should be careful not to be taken in by these imposters. Features like superior products, outstanding marketing strategies, and high-performance management teams are all wonderful attributes for a business to have. But on their own, they are not enough to provide a long-term competitive advantage. Products and marketing tactics can easily be copied, and so require the presence of a deeper, more durable barrier to support and protect them from would-be thieves. So make sure that you'll only invest in companies with moats that generate superior shareholder returns over the long run. And you should also be extremely selective and focused on wide moat stocks. Although economic moats tend to be more qualitative than quantitative in nature, there are a number of ways you can recognize when a company has one or more in place. A significant amount of cash flow and a strong operating performance are common to all businesses with an effective economic moat. But here are 5 other factors that play a vital role in the establishment of a sustainable competitive advantage. In this module, we'll talk about cost advantage, efficient scale, intangible assets, network effect, and switching costs, and how a company can utilize these wide moats to gain the upper hand over their competitors. In the next video, we'll talk about the first one, which is the cost advantage. Okay, see you in the next video. In this video, we'll talk about the advantage of having lower costs. A business that has the ability to sell its goods or services for less than its competitors will have a distinct competitive advantage in the marketplace. Naturally, the only way to accomplish this and still earn a profit over the long term is to be able to manufacture a product or provide a service at a lower cost than everyone else. This is often the case for larger companies with the resources to buy in bulk or to operate more efficiently for a lower cost, and also for those types of businesses that can be effectively located close to both the source of their income and to their customers, such as in the case of a local quarry. And here's a quick note. You'll want to look for companies with a cost advantage that competitors cannot replicate. Remember that an economic moat should be something that's sustainable and cannot be easily duplicated. This means that if you want your company to have a sustainable competitive advantage, you must make it hard or impossible for your competitors to copy your methods. Similarly, companies can do this by developing and patenting new technology before their rivals. So that's why when evaluating a company, you should also spend some time reading its quarter and annual reports to see if they invest any money in R&D. Companies with significant cost advantages can undercut the prices of any competitor that attempts to move into their industry, either forcing the competitor to leave the industry or at least impeding its growth. And companies with sustainable cost advantages can maintain a very large market share of their industry by squeezing out any new competitors who try to move in. You now understand the cost advantage. In the next lecture, we'll talk about the size advantage. See you in the next video. Besides having a cost advantage, a company can gain the upper hand over their competitors simply because it's bigger. Sometimes the sheer size of a company, in conjunction with the small size or niche-like nature of the market it serves, is enough to deter potential competitors and to serve as a wide economic moat. At a certain size, a company achieves economies of scale. This is when more units of a good or service can be produced on a larger scale with lower input costs. This helps reduce overhead costs in areas such as production, financing, advertising, etc. Big companies that compete in a given industry tend to dominate the core market share of that industry, while smaller players are forced to either leave the industry or occupy smaller niche roles. When a company has a relatively exclusive monopoly, for example, it means it controls the supply of a particular product or service within a certain location or industry. This makes it very difficult for similar companies to get a foothold in the same market, since the established giant in the neighborhood has already claimed most of the available customers and has sufficient size and resources to do whatever it takes to hang on to them. In addition, when a company is big and it has lots of cash flows, it's much easier for it to grow by simply acquiring other businesses. A good example is Apple. For example, if Apple wants to develop a new headphone product line that will be used for upselling and increasing their lifetime customer value, they simply go out there and buy an excellent headphone business. And yes, they actually did. Apple bought Beats in 2014 for over $3 billion. And now they have great headphone products to sell in their stores without spending too much time and effort building them. It may take Apple's competitors years to build the same headphone business. And of course, they'll have to do a lot of work. By having a size advantage, Apple is clearly doing better than its rivals. So, as a value investor, you'll want to invest in companies with a size advantage. In the next video, we'll dive into how a company can create an economic moat with its intangible assets. See you in the next video. Okay, in this video, we'll talk about the possession of unique assets. Another type of economic moat can be created when a company invests in developing and building its own intangible assets. Examples of such assets include things like patents, a strong and widely recognizable brand name, copyrighted intellectual property, and specialized permits or other kinds of government-issued licenses. These types of assets provide a natural economic moat for the company's continued and profitable business operation. Strong brand name recognition allows these types of companies to charge a premium for their products over other competitors' products because they offer customers something that's limited, exclusive, or difficult to replicate, as well as something that's often known for having a predictable level of quality. The perfect example might be Nike, which started out as a simple athletic apparel company but has since become a major cultural institution and a purveyor not only of gear but of status. Designer fashion labels have similar business models, using their prestige to sell clothing for prices several times higher than the cost of production. Not only does intangible assets help a company survive in the long run, they also help prevent other competitors from duplicating the company's products because they are protected by copyrights and patents. In addition, I want you to take note of this. Popular brands aren't always profitable brands. If a brand doesn't entice consumers to pay more, it may not create a competitive advantage. That's a red flag telling us that the management is not doing a good job to increase the business earnings and cash flow. From an investor's perspective, a popular brand means nothing to me if it's not profitable and if it doesn't show any promise for future growth. As an investor, what we care about is how we can make a return on our investments. If a business is not profitable, our investment won't be profitable, and we'll likely take additional risks of losing our money. So make sure you pick your stock wisely. In summary, you should look for companies that are protected by the advantage of a premium brand name, a tightly licensed product, a loyal customer base, and an industry with extremely regulated and complex entry requirements. And you also want to make sure the company's management knows how to utilize these intangible assets. In the next video, I'll talk about the network effect, which is another way an economic moat can be created. Okay, see you in the next video. In this video, we're going to talk about the benefits of the network effect. When a business has the built-in ability to both grow and improve as it gains more customers, it is said to benefit from the network effect. In these cases, the more people who use a certain business, the bigger its market share gets. But more importantly, the more exclusive its hold on that share becomes. This is simply because having more users translates into a more valuable product or service for all, and inherently leads to a never-ending cycle of continuous growth. The network effect is an extremely powerful type of competitive advantage, and it's most often found in businesses based on sharing information or connecting users together. You don't see it much in businesses that deal in physical goods. Examples of this can be seen in companies such as eBay, Visa, and Facebook. The more people who use these particular services, the better the experience becomes, which leads to more people using the services. The network effect gives a company a lot of advantages over its competitors. Looking at Facebook, for example, Facebook becomes more and more profitable when more people use it. You know what? Facebook has access to a database of billions of people around the world. So this means they can easily make billions of dollars just by utilizing their customer base. You see, the network effect makes it hard for other companies to compete with Facebook, because if they want to enter a competition, they must spend a lot more money on advertising and a lot more effort on reaching more people and showing their products. In the case of Facebook, they can reach billions of people without any hassles. You can guess who will win in this game. This competitive advantage can be difficult to dislodge once it gains momentum, and so it offers a potentially enormous economic moat to the lucky company or two that managed to establish the first successful networks in a particular industry. So make sure that you'll look for companies with a strong network effect. They are always winners in their industry. In the next video, we'll talk about how a company can create an economic moat by commanding high switching costs. Okay, see you in the next video. Okay. The final way a company can go about building a sustainable competitive advantage is integrating high switching costs into their business. Switching costs are expenses or disruptions a customer will encounter when switching from one product or service to another. It's beneficial for companies to create high switching costs, as doing so can help them retain customers. Cell phone service providers, for example, can lock in customers because of their high switching costs. To change providers, a customer might need to terminate an existing contract and purchase a new phone, both of which can be costly. As such, customers might be less motivated to switch providers even if they're dissatisfied with their current service. You see, how well a company is doing is determined by its ability to maintain its customer and supplier base, regardless of how fierce the competition is. When a company provides a customer with a product or service that is difficult to break away from, in terms of cost, time, or convenience, it's far more likely to hold on to that customer over the long term. And this makes competition more interesting, because if the company's competitors want to gain more market share, they must offer an extremely attractive price or performance alternative to entice consumers to switch from their current provider. Their competitors will have a very difficult time taking market share away because of these cumbersome switching costs. In many cases, customers just aren't interested in dealing with the fees or aggravation involved in making the switch, regardless of how appealing a competitor's offering is. Not only does this fact allow the company to maintain a strong customer base, it even makes it possible for them to incrementally raise their user prices over time in order to consistently increase their profits. That is to say, when a company is able to establish itself in an industry, it can have higher pricing power over its competitors, and this is something that will help it survive over the long run. So, as a value investor, make sure you'll look for businesses that are industry leaders, and they know how to integrate high switching costs into their operating and marketing practices. In this video, we'll talk about the complete value investing roadmap so you'll know exactly your next steps and what you'll need to do to become a successful value investor. As you've already learned, by implementing the value investing strategy, you'll need to follow these 3 simple, easy steps. First, we'll look for companies with a strong financial and operating performance. What we want to do as a value investor is to make sure that the company we're investing in has enough capacity for maintaining its operations profitably, as well as having an ability or strong economic moat to compete with its rivals in the same industry. You can evaluate if a business is financially strong or not by looking at some financial ratios and performing a financial statement analysis. You'll need to look into your company's balance sheet, income statement, and cash flow statement to find out what's behind the numbers. And when you found a solid company, the next step is important. You'll need to make sure that it's undervalued. You can easily determine if a stock is undervalued or overvalued by performing a stock valuation based on some method like the discounted free cash flow model. After estimating a company's intrinsic value, you simply compare its intrinsic value with the current market price. If the intrinsic value is greater than the current market price, the stock is considered undervalued. And on the other hand, when the intrinsic value is lower than the market price, the stock is overvalued. It's simple as that. And always make sure you'll apply a margin of safety to make sure that you'll actually buy an undervalued stock. However, knowing a company's intrinsic value is not enough. That's because you'll need to find the best opportunity to buy it. A great company can easily end up being your worst investment when you buy it at the wrong time. And that's why technical analysis is essential in your value investing system. By utilizing technical analysis, you'll know exactly when to buy your stock to maximize your profit while reducing your risk. And the final step is sell your stock when it becomes overvalued. Again, you can determine the best time to sell for maximum profit by using both stock valuation methods and technical analysis. So that's the 3 simple steps you'll need to follow. Now, let's talk about the roadmap for mastering the value investing technique. I've been a value investor for 7 years now, and here's what I've learned to become a master. To become a profitable value investor, first and foremost, you'll need to learn all the best value investing strategies to find solid and financially strong companies to invest in. That is to say, you'll need a system. You'll need a set of investment criteria for evaluating and picking undervalued stocks. By having a system, you can make sure that all the companies you choose are rock-solid companies, and you can easily automate your stock analysis and valuation process. You can either build your own system or simply follow our copy and paste value investing system. After knowing all the strategies that actually work, you'll need to enhance your expertise so you can understand better all the businesses that you're investing in. You'll need to learn more about financial ratios and how to read and analyze a company's financial statements. If you were an accounting or finance student when you were in college, you might have gotten familiar with these topics. But if you're not a finance person, learning these topics may be a little bit harder for you. But they are essential if you want to be successful as a value investor. So learn it well. Next, you'll also need to learn more about stock valuation. At least you should master how to use the discounted free cash flow model so you can project future cash flows of a company and estimate its intrinsic value. And when you're done with the intrinsic value, things will become much easier. Your next step is to use technical analysis to determine the best time to buy and sell your stocks. By using technical analysis, you simply look at a stock's chart and determine current market trends and predict the future movements of your stock. You'll need to look at some technical indicators and oscillators like the moving averages, the RSI, the Bollinger Bands, volume, the MACD, etc. And you can also look at chart patterns and candlestick patterns so you can predict if your stock's price will go up or down in the future. And the final thing, you'll need to develop a strong winning mindset and learn about trading psychology. You'll also need to know what affects the price of your stock, how to trade at minimal risks, how to reduce risks on your investments by placing a stop loss, etc. So, that's everything it takes to become a profitable value investor. You know, value investing is a big subject, and it does require some kind of expertise, a lot of work, and patience. But you know, value investing will eventually pay off. I promise you that. Imagine you can grow your investments by at least 15 to 25% a year by just following a simple system that you can create on your own. That's much easier than putting your money somewhere else, like in the bank or your 401k and IRA that generally pay you nothing in return, or a small fraction of the return you could have made. So, welcome to the value investing world. I believe you can do whatever it takes to become a better investor, and you can change your financial future.